Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look through, is Safestore Holding PLC stock a buy now? I had a look at this stock a few months ago, but now we're in 2025 and this stock has plummeted in price recently, so I want to dive deeper into it and see if it is undervalued and if you should be taking advantage of this recent dip in price. What is Safestore Holdings? It is a self-storage company and it has approximately 178 stores, comprising 129 wholly owned stores in the UK. The remaining stores are mainly situated in France, Spain and the Netherlands, and the firm has carved a niche for itself as a leading self-storage operator in the United Kingdom and France. The company's business model is straightforward yet highly effective by providing individuals and businesses with secure, flexible storage solutions. Safestore's extensive network consists of strategically located self-storage facilities which are designed to cater to the varying needs of its clientele. Each storage unit offers different sizes and specifications, allowing customers to choose according to their specific requirements. The company generates revenue by leasing these units on short to long-term basis, embedding flexibility and accessibility at its core of its offering. Some key stats to do with Safestore Holdings is they are based in the United Kingdom. They are part of the real estate industry, have a market cap of 1.4 billion. They went public in 2007, have over 650 current employees. They have a dividend growth streak at 14 years, 5-year dividend growth rate 12.65%, and a current dividend yield sitting at a very healthy 4.84%. Over the last year, we can see they are down dramatically by 24.76%. And since their most recent earnings call, they've had a little dip as well. So that is why we're going to dive deeper today and see if they are a buy right now. Next up, we're going to have a look at Safestore's earnings call and fundamental analysis. Safestore Holdings reported that profit for the fiscal 2024 grew, while revenue declined year on year. Their EPS moved to £1.70 from 92p. The UK-based self-storage company's revenue was £223.4 million this year, and if we compare that to last year at £224.2 million, this means that this year they are down £800,000 in revenue. On first glance, it doesn't look a great viewing. However, I think the recent market reaction is a massive overreaction to that slight miss in revenue. Meanwhile, the board recommended a final dividend of £0.204 per share for this period, payable on April 15th to shareholders on record on March 14th. It paid £0.202 per share a year ago, and the full dividend yield for the year is £0.304 per share, which is actually up from it being £0.301 per share last year on an annual basis. Some key fundamental analysis to do with Safestore Holdings is they have a positive free cash flow at £103.5 million, positive net income at £264.2 million, positive operating income at £133.6 million, positive gross profit at £152.2 million, very good ROE at 14%, good long-term solvency, low debt to equity at only 0.4. They have an average Altman Z-score at 2.01 and average interest coverage at 4.88. And the only real negative to the company is their positive net debt at £804.8 million. Moving on, we're going to dive a little deeper into their free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading. As you can see from the graph, Safestore has some very impressive growing free cash flow numbers. This is especially impressive as they are a REIT, so have to distribute out over 90% of taxable income every single year. Another positive sign here is how well they've performed during COVID. That is due to the type of rental agreements they are involved in, so COVID had little to no effect, and this gives me massive confidence knowing that if any future surprise events take place, they will more than likely be unaffected. This is very important for a company like this, as you want to be as certain as possible that they will be able to continue to grow that dividend yield and at a very good rate. Not to mention they only have a payout ratio currently at 67%, so this only adds to the fact that they are likely to continue increasing that dividend payment in the years to come. Next up, we are going to have a little look at Safestore Holdings' discounted cash flow valuation. DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on selected operating models. Safestore Holdings' current price is 624 GBX. And when using a discounted rate at 8% with a terminal growth rate at -3%, we can see Safestore Holding was valued at 378.89 GBX. When using a discounted rate at 7.8% with a terminal growth rate at 0%, we can see that Safestore Holding was valued at 664.15 GBX. And when plugging in a discounted rate at 7.6% with a terminal growth rate at +3%, we can see Safestore Holdings value would be at 1,174.67 GBX. I not only look at the discounted cash flow valuation when valuing a stock, but also the relative valuation. This is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics it includes is EV to revenue, EV to EBITDA, and PE ratios. When plugging in my numbers on the worst case scenario, they valued Safestore Holding at 1,098 GBX, on the average case being worth 1,206.6 GBX, and on the best case scenario, they valued Safestore Holdings at 1,322.74 GBX. I'm really excited to announce that today's sponsorship is from none other than a really cool dividend tracking app called Snowball Analytics. I think you'll like it a lot and I want to tell you more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Rolls Royce of portfolio trackers. I have personally been using this app since the start of my investment journey, and I'm extremely impressed by how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and I find the platform very easy to navigate. Plus, it's packed with so many different charts and graphs to do all the hard work for you, so you can really understand different aspects of the portfolio. It not only dives deeper into your own personal portfolio, but also into individual stocks as well. Pretty much anything you want to know about a company's financials or dividend history can be found here within the Snowball Analytics app. In my opinion, what really sets Snowball Analytics apart from the rest is the features that it has designed specifically for dividend investors. This app tracks your portfolio so closely and has a very robust event calendar that shows you all relevant information you need to know about your stocks, as well as potential income coming in, and it predicts the income you are likely to receive in the future as well. Not only that, it adds total returns to your stock with the dividends you have also received, which no other dividend tracking app can do. This is so important as it can really show you the bigger picture and highlight how well your portfolio is actually performing. If you are interested, then please click my link in the description to check out Snowball Analytics. You can also get a free 2-week trial so you can try it out for yourself first and see if it's for you. Let's get back to the video. Since we now have the DCF valuation and the relative valuation, we can combine the two together to come up with something called the intrinsic value. The intrinsic value has been used for many years by many different investors when valuing a stock, hence why I like to use it in my valuation method. Remember, their current price is £6.24. My worst case scenario, they were valued at 739 GBX, average case being valued at 935 GBX, and on the best case being worth 1,248 GBX, also known as £12.48. The final valuation method I look into is something called the Wall Street estimates. The reason I looked into this as well is because I believe that they are a fairly accurate valuation method due to a company-specific analyst providing research on that particular company and looking at all of their quarterly earnings and revenues that lead to that particular valuation. For Safestore Holdings, their worst case scenario, they believed it would be worth 767 GBX, which is actually a 23% upside on that current price. They believed on average case they would be worth 944 GBX, which is actually a 51% upside on that current price. And they believed on the best case scenario for Safestore Holdings, they would be worth 1,312 GBX, which is a massive 110% upside on that current price. Overall, Safestore Holdings price, as mentioned in the previous slide, is £6.24. So now I have all three valuations. I can combine them together to get my final worst, average and best case scenarios for Safestore Holdings to see if it is trading at an attractive price. On the worst case, I believe Safestore Holdings is worth £7.48. On the average case being worth £9.38, and on the best case being worth £12.69. So with a 10% margin of safety on that worst case price, you'd be looking to buy Safestore Holdings at £6.73. And with a 20% margin of safety on the worst case price, you'd be looking to buy them at £5.98. On the average case price with a 10% margin of safety, you'd be looking to buy them at £8.44. And with a 20% margin of safety, you'd be looking to buy them at £7.50. And finally, on the best case price with a 10% margin of safety, you'd be looking to buy Safestore Holdings at £11.42. And with a 20% margin of safety, you'd be looking to buy this stock at £10.15. What does this mean for Safestore Holdings? Is the stock a buy right now? I think this is one of the most underrated UK REITs on the market right now. It is still showing to have really strong fundamentals across the entire company, and I believe the recent drop in price is a massive overreaction to the recent earnings call I talked about earlier in the video. If you take a step back, I really didn't see anything that concerning personally, but I'm certainly not complaining, as it means I can now buy in at the stock for a cheaper price. To back this up further, the company has free cash flow numbers that most companies could only dream of, never mind it actually being a REIT. So for it being a REIT specifically, it just makes it even more impressive that they have such strong free cash flow numbers. For us dividend investors, the average 5-year dividend growth rate is sitting at over 10%, alongside that already impressive 4.88% yield and a low payout ratio, only 64%, shows it really does tick all of the boxes on that front. I see Safestore Holdings as one of the best valued stocks in the UK right now, and looking through my valuations, it is comfortably in the buy range on the average case price with a 20% margin of safety, but more impressively, on the worst case price with a 10% margin of safety, it is still considered a buy right now. Do you currently own this stock, or are you looking to add this stock to your portfolio? I hope you enjoyed today's video. If you want to see any more stock analysis, please let me know of the different stocks in the comment section down below. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.